Plus, we know what they're going to do, so it's going to be anticlimactic, is it not?
Well, no, not really. I think they can talk a lot. In fact, I would find it very exciting. The fact of the matter is they have to articulate to people as to what the driver of all of this is. And that is really the critical thing. Whether it is 25 basis points or 50 basis points doesn't really matter. What matters is they're rolling back the tightening that they did last year, or at least second half of last year. And what is the logic behind that? That is very important because that tells you what the future path is going to be for quite some time. I think the most important thing right now is the fact that they are easing ensures that they are not going to be tightening for at least 12 to 24 months. That is the most important thing for the markets.
Greg.
So our concern is, we expect 25 basis points. Back in December, though, it was still moved towards tightening. So this is kind of a huge switch. We think it's mostly symbolic. The problem that we're seeing is the growth in credit. The growth in credit and the quality of credit that's being pushed into the public markets is the ticking time bomb in the market. And although the numbers look good, you go back to August of 1968, you'll see 3.5% unemployment. Like we're coming down that low, but when it shifts, it's going to spike. And I think we're just waiting on it.
Well, I think the concern about growth and credit is important, but one thing that we have to remember is the fact that without growth and credit, there will be no growth.
Right.
So I think that goes together. I think the quality of credit growth is something to be concerned about. But if you look at for the majority of the corporate bond market, the coverage ratios are actually quite decent. So it's something to be worried about, but not to go overboard.
What about the other side of it, though? I mean, people, when we talk about the Fed cutting rates, the concern is that you're going to just continue to push asset prices up. And the credit sector, the corporate credit market, is an area that people point to as one of the perhaps more vulnerable sectors of the market. People have been forced into the credit sector to get yield, and that's a relatively illiquid. So is that the angle in terms of the corporate credit concerns, that maybe we more than the leverage and the ability to service the debt, the potential that that's a sector where you could see some overheating?
Yeah, so it's the public credit, investment grade credit, we actually think looks good. It's that middle market leveraged loan part of the market that's been pushed off the bank balance sheet into the markets. That's the problem. That's where we're seeing more cov-light type of issuance and the deterioration in the quality.
I would say, again, on that particular point also, we just have to maintain a little bit of perspective. It's the growth in the private credit market isn't just about bad credit getting into or bad credit getting loans. It's really more about disintermediation. As the banks pulled back, and as people were looking for higher yield, it provided other intermediaries away from banks an opportunity to lend to people that the banks wouldn't lend after the financial crisis.
Michelle, the Federal Reserve in 1998 and again in 2007 cited international concerns when it cut rates. Right. It's hard for me. It's not impossible that it could be the same, but it's hard for me to see similarities between 1998, the LTCM blowup, the Asia crisis, the Russian financial crisis, 2007, you know what happened on thereafter. Between those times when the Fed cut, citing international reason, and what's going on today, I get that we have a global slowdown in manufacturing, but I don't see a global crisis.
Well, and in 98 in particular, not only did they cite the international concerns, but they cited the tightening in financial conditions, which is, of course, absolutely not the situation right now, with financial conditions quite accommodative at this point. The angle, though, I think is important, that I think we'll hear more about this week, is the low inflation numbers, the inflation miss.
Right.
I think that that's something that the Fed, in trying to thread the needle about explaining why you move when the economy is strong without sending an alarm that you're quite concerned or more concerned about the economy, I think as you talk more about the inflation impetus behind this. You're missing on your inflation mandate. You want to get inflation up towards target. That is a significant driver, as much as the growth concerns. I think that will come through.
I think when we kind of think in just plain and simple economic terms, it becomes somewhat challenging to see why the Fed is doing what they are doing. But if you frame
because
it
the Fed didn't say it was data dependent.
No, exactly. I think that's the key thing. What they are saying is we are effectively unwinding or what they should say is we are effectively unwinding the tightening that we did last year, which, given the market conditions specifically with respect to inflation, really wasn't warranted. So I think that pivot in December eased financial conditions. Without that, we would be in a very tight financial condition situation, and growth would slow down precipitously. Very wise move on the part of the Fed.
Well, the Fed has to put it through the lens of inflation, because it can't, based on its mandate, say, well, global yields are telling us we're in a deflationary world, and therefore we have to get our rates in line with
dual
what
mandate.
They're doing. But, Greg, I guess the big question, though, is, are markets priced for this scenario exactly? Do we so know what's going to happen? The market closes last week, S&P at an all-time high. The volatility index is at 12. There's no real stress in the credit markets right now. So can you build upon that when we get just an expected rate cut?
So it's going to be hard. The markets are priced to perfection. Look at historic returns just year to date. These are phenomenal returns both for domestic equity and fixed income. Second half of the year is going to be challenged. We're looking at single digits, and that's the challenge for investors.
Single digits on top of what we got.
Mike, I think a lot of it depends on the guidance we get. And I think that's where there's a big question mark. Do they cut 25 and say, now we're going to hang out for the rest of the summer, or at least part of the fall too? Or do they say 25 and more to come?
Yeah.
Well, I think it's 25 this. What they do in Jackson Hole is actually quite important in terms of what future policy path is going to be. And thirdly, what happens with respect to growth. Our expectation is growth probably picks up somewhat, and as a result, the markets can probably go higher.
We heard they need to be dovish. They need to out-dovish expectations.
This business the reason I brought it up this morning, because I hadn't heard other people talking about it, of the cut,
right,
and then stopping the balance sheet reduction. I'm not quite sure that's priced in by the market. And I like what was said earlier here by Krishna, this idea that if they cut, it's hard to think about them possibly tightening again for 12 months. I'm not sure that's in the market. This idea that they're not going to do a triple axle, right? Where they cut, where they hike, and then they cut, and then they go again. I don't think it's going to be, or at least a double axle.
Did you see when Mnuchin was on? Andrew, I kept asking him about the dollar. Going to weaken the dollar.
He doesn't like to talk about that.
No, I know, but meanwhile, they were talking about that.
That was unbelievable.
Right.
Yeah.
They had a meeting about weakening the dollar.
They did.
Well, I think weakening of the dollar is for a domestic economy like the U.S., focusing too much on the dollar probably doesn't do you much good.
I mean, Larry must be apoplectic.
Yeah.
Kudlow. I mean, that is never, number one, they did it. Number two, they admitted it, that they talked about it. But they said they're not doing it for now. That's all they said, right?
But the idea that Navarro had a PowerPoint presentation.
That's what I mean about weakening the dollar.
I mean, it was a PowerPoint presentation in which they talked about capital controls.
That would be something.
They talked about it.
Never say never.
Shut down.
Never
but
say.
they talked about it.